Let's get down to business. This morning, a new report from the Commerce Department showed that the U.S. economic growth slowed to 1.5% in the second quarter of this year. This comes after the Federal Reserve voted yesterday to keep interest rates steady in the 3.5% to 3.75% range. But there was pressure from inside its own ranks to raise the rates. 3 regional Fed presidents voted for a hike, underscoring their concerns that the central bank is not doing enough to handle rising inflation. Natasha Stern, president of the Budget Lab at Yale University and former Treasury official, is here. And Rick Newman, author of the Pinpoint Press on Substack. It is a must-read if you follow the economy or markets, and a former columnist at Yahoo Finance. Okay, so we have economic growth slowing. The market, while it has been extraordinarily strong, it is starting to show signs of weakness. Yesterday, it dropped more than 1,000 points. And the Fed chair, who walked into that job with huge pressure from this president to cut rates, is basically signaling patience.
Well, let's talk about the Fed event yesterday. This should have been a non-event. The markets expected no change in interest rates. That's exactly what happened. We got no change. And yet there was this big market reaction with long-term rates going up. I think ordinary people must be completely confused. OK, the Fed didn't change interest rates, and yet interest rates are going up.
Why?
So the Fed controls short-term interest rates. Those affect mostly banks. It does not directly control long-term interest rates, mortgages, consumer loans, car loans, business loans. And investors think we're going to have worse inflation in the future. So we've got those interest rates going up because return on bonds has to go higher if you think there's going to be higher inflation in the future. So the ironies abound here. This is the guy who Trump wants to lower interest rates. And, basically the day he gets into office, interest rates are going up.
It's so interesting because if you look at what the market is expecting come September, they're expecting with 60% probability a rate hike. But yesterday in the press conference, Chair Warsh, he did everything he could to say other words other than the possibility that interest rates need to rise. And that actually is what spooked the market, because the sense is that this isn't a Fed that's going to be credibly committed to getting inflation back down to target and willing to use the tool that it has that's most likely to effectuate that, which is interest rate increases. And so it is actually not, if you look at what other members of the Federal Reserve Board, including Chris Waller recently, has been saying, the idea that you can just stare at inflation and it'll come down because of the withering gaze of the Fed is not a credible policy. So the Fed actually needs to be in a position where it's willing to act. And I think yesterday in that press conference, you were hearing concern that maybe Warsh isn't really quite committed to that goal.
I think you could say Warsh bombed. I mean, he's getting terrible reviews. He confused markets. He talked like a hawk, but did nothing. He's already losing credibility. And that's why we saw this kind of weird reaction, which is long-term rates going up, even though the Fed did exactly what everybody thought it would do.
Right? Because the bond market is the daddy, right? It doesn't necessarily matter what he says. The guardrail that Donald Trump, the one guardrail he has over and over is the bond market. We're now looking at 30-year yields, the highest they have been in at least 16 years. Now, we do not have a market native audience, but explain to us what that signals about the state of the economy when 30-year rates are doing what they are.
So let's talk about mortgage rates. So 30-year rates and 10-year rates, that's the bond market, but those directly affect mortgage rates, and that's something everybody can understand. So before the Iran war, in February, mortgage rates, the average mortgage rate was 6%. It's now close to 6.7%, and that is because the Iran war created inflationary pressure. Nobody knows if it's going to last. No one knows when this war is going to end. So if you're buying a house, I did the math the other day on a typical house. That's about an extra $130 a month, more than $1,500 a year from mortgage rates going from 6 to 6.6 or 6.7. So, and that's happening all across all mortgage rates. If you get a car loan, it's the same thing.
And this week's just after our president did everything he could to block an affordable housing bill. And then, alas, he wasn't able to. All of this is happening while the president is initiating new tariff policies.
And all of those are, in fact, inflationary. In part, what this uptick in the long rate is telling you is it's telling you that the belief of investors is likely that there is going to be inflation in the future. And as a result of that, over the course of the medium to long-term horizon, you're going to see interest rates continue to rise. And so I think a little bit what your viewers should understand is that the costs of higher interest rates that they're already bearing today on their mortgages or on their car loans, those those aren't going to be with us for a short period of time. They're kind of like baked in to the apparatus of what we should likely expect over the course of the next many years, in part, frankly, because the government is running these large deficits and debt is so high that investors in the United States debt are demanding higher interest rates, and that trickles down to the rest of the economy.
You know what's amazing? Before Donald Trump won, I saw Scott Bessent speak at an event, and he was passionate. He was panicked. He was irate over what debt and deficits looked like in this country. And said it was criminal what Joe Biden was doing on the deficit front. And now look where we are. It is ballooning under Donald Trump.
It's gotten much worse, right? We're in a situation, when this administration took office, we were in a situation where we weren't on a great trajectory, to be clear. But debt to GDP ratios were expected to be in the high 120s over the course of the next 10 years. That doesn't mean much to your audience, but what they should understand is that we've added $2 to $3 trillion of increased deficit spending as a result of the tax cuts, as a result of the Iran war, and as a result of the spending that we've seen over the course of the last many months in this administration, and DOGE, which is costing us very significant tax revenue. So we're in a situation where we're making our problems worse, not better.
We're out of time, but I just have to make the point. DOGE, which is costing us. And just in the last week, Elon Musk sat down for an interview with The Economist. And in that interview, he said, AI is going to put us in such an economic bounty, in such a state of abundance, the American people will want for nothing. He predicted that would be the case in the next 5 years. The clock's ticking. We're watching. Rick, great to see you. Natasha,
Thanks.
Fabulous to have you here.